Welcome back, goal learners. Today we are going to be diving in deep into the stock trading course, and today we are going to be talking about the first thing that is needed to be known to be an investor: investing. I want you to note that during the course of this lecture we are going to be giving you paradigm shift on what is popularly known. So investing is the act of allocating resources, usually money, in expectation of profit over time. Now, the general public usually have this wrong perception of investing. So they feel investing should be made quickly. Investment should be made quickly in expectation of huge profit, huge returns. That's not what investing is. Investing is allocating your money and putting it to work over time to give you profit. Now, whenever the characteristics of investing, whenever you invest, there are three things you need to put in consideration: the risk, the liquidity, and the duration. Now, there's this popular saying in the investment space that says the higher the risk, the higher the reward. And this goes to say that the more risk you are willing to take on, the higher the chances your rewards will be, the higher rewards will be. So the general public, paradigm shift moment, the general public feels like they should risk less but have greater rewards. That doesn't go in line. Naturally, the investment space feels that the general public, the uninformed general public, usually feels that they should risk less but have greater returns. That's why they end up falling for scams and Ponzi's and the likes. So there should be one thing you should know. If there's anything you should know about investing: risk. The higher the risk, the higher the reward. The lower the risk, the lower the reward. But there are cases where there are special cases over time where I would put you through under where you can still risk less and earn more. That is on a special ground. As we go on in this course, I will show you how that is done. Now, while the second characteristic of investing we should always look at is liquidity. Now, liquidity is the act of transacting an asset without changing its price over time. Now let me explain. If you are to buy a house worth 10 million today, it is not possible for you to sell that house the next day for 12 million. But if you are to buy a cryptocurrency or a stock, the speed at which you will sell it, no matter the price, is more faster than the house. It shows that the house is illiquid, not liquid, while the asset, the stock or the cryptocurrency, is a liquid asset. So there are two forms. We have the liquid asset and the illiquid asset. The illiquid assets, we have landed properties. Landed properties are mostly illiquid assets. But while talking about the liquid assets, we have stocks, we have financial instruments, mostly bonds, commodities, and the likes. Now, the last part that we always need to look out for while investing is the duration. Is it short term or long term? Most investors, especially the uninformed general public, they have this perception that investing is a get rich quick scheme. No, it isn't, unless it's a Ponzi or a scam, obviously. But most times, the duration has to be in check. How long is this going to last? How long are you willing to put your money to work? That is the characteristic. Those three things I just talked about are the characteristics of investing.